The RBI earlier this month had tightened the noose around unsecured lending, which of course is going to have a direct impact on anybody out there wanting to seek a personal loan that doesn't have a collateral attached with it, or even credit cards and banks and NBFCs and fintechs which are willing to offer you credit no matter what your credit worthiness is. Well, all of that is now irking the Reserve Bank of India and also being seconded by Finance Minister Nirmala Sitharaman. And RBI has recently taken that initiative of increasing the risk weight on unsecured lending. Well, joining us this evening is Adhil Shetty, CEO of Bank Bazaar, to help us understand and make sense of what is really going on here. Hi Adhil, thank you so much for joining us. Let me go straight into what has really happened. RBI has increased risk weights on unsecured loans. Are unsecured loans indeed such a big concern on the books of banks as you see it?
When the RBI made this change, what they called out is that unsecured loans are growing faster than the overall credit market. So if we look at the last couple of years, unsecured loans are growing at a 24% compounded growth rate, while the entire market is growing, closer to that high teen rate. So the RBI is not called out saying that we've seen higher losses. We've not seen higher losses in any of the reports that are coming out. But, a good time to start building prudence and risk management when things are still good. So this is almost like a early prudent measure to ensure that losses don't build up in unsecured loans, that the RBI is doing it when things are still going good. And broadly, they're saying all sectors, all subsectors in credit should grow at the same pace. So a rule of thumb is credit should grow at 3x of GDP. So if GDP grows at 6.5%, retail credit should grow at 19.5%. So we might see a reduction from that 24% closer to 19%.
All right. So Adhil, help us break it down even further. What is the impact really on the end consumers? What is really going to happen now? Will personal loans get more expensive, or are personal loans going to be harder to get in the first place?
It's a great question, and it's going to play out in phases, but I'll try and give you a quick answer, all right? So essentially what's going to happen is, because the banks have to set aside more capital, the cost of funds or cost of capital in doing business is going to increase. So we estimate that on the credit card side, the cost of funds is going to increase anywhere between 0.2% to 0.4%. Now, typically when cost of doing business increases, right, there are three sectors of consumers who are impacted differently. So for the consumer who's high credit score, above 750, and this is what we advise people at Bank Bazaar, keep your score of above 750. Most likely for these people, anyway, the loss rates are low. So nothing is going to change for the 750 plus credit score consumers. That's bucket A. Now, bucket B, right, is consumers with a score below 650. This is the risky 10,000, 8,000 rupee personal loan, people who are rotating and taking a loan to pay off a loan. That risky segment, right, in order to recover the increased cost of capital, potentially the loan offers will stop. So in this segment, it's going to be harder to get a loan, because that loss the banks want to avoid, and they want to save that 0.2% increased cost of capital. So in the most risky segment of people who are rotating or taking risky loans, right, that segment the offers will reduce. Now in the middle, we'll need to see what happens, because if stopping the risky loans takes care of the additional cost, then nothing further is required. But even if stopping the most risky segment does not take care of the additional cost of capital, then we might see a calibrated increase in costs for the middle segment.
So, all right. So, as I understand it, those who have a credit score of below 650 are the ones who need to worry. But from the perspective of industry, Adhil, specifically NBFCs, will NBFCs, end up becoming the biggest losers in this game, because they find themselves borrowing from banks and then lending to end consumers?
Yeah, so the RBI clearly has called out in its notification that the risk-weighted cost of capital from banks to NBFCs has also gone up by 25%. So clearly this segment has also been identified. Now it's going to be a waterfall, right? So the bank's cost of capital is going to go up when it lends to an NBFC. An NBFC has to hold additional risk weight. That's going to go up for the NBFC, and that's going to translate into a cost of capital. So again, without going into the detailed explanation, the NBFC is going to do the same thing. The consumers who are doing very well, high credit score, low loss rates, it's a competitive market.
Okay.
Those people most likely are not going to be impacted.
Okay.
Now come to the most risky segment. Small ticket loans, unsecured, people rotating loans, 5,000, 8,000, 10,000. The segment, right, that reports have been saying is the fastest growing segment.
That's
So
right.
a couple of the bureaus have put out reports and they're saying that this unsecured 10,000 rupee personal loan is the fastest growing, which clearly, right, is the segment everyone is most concerned about. This segment less offers. So the same thing that's happening with the banks is going to happen with the NBFCs and will translate similarly to their end consumers.
Okay, but then this consumption that you're talking about, Adil, and this consumption, of course, I'm not just talking about the low segment consumption, the 5,000, 10,000 rupee loans, but eventually these loans and this credit is driving consumption overall in the country, and consumption being a growth driver. So in turn, will the RBI's move actually impact overall economic growth?
See, I think the RBI has done the right thing because the RBI has said all sub-segments, meaning unsecured, secured, all sub-segments should grow at a similar clip. That's what the RBI has said. So the RBI has not said that the sector will degrow or the sector won't grow. They've simply said all subsectors should grow at a similar clip. So I think they're just tempering the growth, in my opinion, broadly from a 24%, maybe closer to that 18, 19% or 3x of GDP number.
Okay.
Because they're saying all subsectors should grow at the same clip.
Right.
Now, it's always better, right, to drive consumption which is prudent. So what I mean by that, right, is no one wins when I consume, I spend, but then I can't repay it back. So that creates a vicious cycle. So it's always better to have consumption that's sustainable. So in that sense, right, I don't think there's anything wrong in saying that have prudent consumption and only have consumption which I can repay back. Because if you look at what's happened in other economies, right, and what happened with P2P lending in China, yes,
correct,
I borrowed, I spent, but if I don't repay it back, right, the impact on GDP is much higher and much worse.
Absolutely.
Than if I do this prudently.
Absolutely. Well, we are running out of time here. Adhil Shetty, but a pleasure having you here with us on Business Plus, and thank you so very much for taking out time.